Every major small cap story in India begins long before the price moves. Not on TV or on WhatsApp groups, not even in brokerage research reports. But usually, when most investors are looking the other way, it begins quietly inside boardrooms most investors will never enter. Over the last few months, a strange pattern has emerged inside a small cluster of companies. A pattern that remains ignored and hidden in regulatory filings that most people never bother to read. A pattern that has historically appeared right before some of India's most powerful wealth creation phases. And it is appearing even now as we speak. You see, a handful of promoters are quietly buying their own shares with their personal money. These purchases are not token confidence building gestures, but recurring, significant, and at a scale that demands attention. You will not see management giving interviews about it or trying to convince anyone. They're simply acting on their conviction. And if history is any guide, when promoters behave like this, it is often with a reason. Today, we are going to decode this behavior for the very first time because hidden inside these silent insider actions is one of the most reliable signals we've ever studied in the small cap space. And the timing could not be more important. Whenever we saw this kind of activity in small caps, the results were extraordinary. Lincoln Pharma jumped 153% in 2 years. Kowai Medical shot up 456% in 4 years and 6 months. Kilburn Engineering soared 130% in just 10 months. Aventel surged 257% in 3 years. Mrs. Bector delivered 562% in just 2 years, 3 months. In each of these stories, the insiders acted first, way before the markets caught up. In fact, the stock of one Gujarat based company was up an unbelievable 2,398% in 3 years and 7 months. These were not momentum or speculative trades. These were companies where promoters themselves took bold positions before anyone else understood what was happening. And right now, a similar pattern is emerging in some companies. That's why this conversation couldn't wait. Not to predict the future, but to decode a powerful signal that most investors overlook. Despite it being publicly available, legally disclosed, and historically extremely telling, this could be one of the most important conversations you will have this year. And I guarantee you, it will change the way you look at the markets. Hello and welcome to this exclusive briefing Promoter Wealth Signal. I'm Trupti David, Chief Operating Officer at Equity Master. We've studied markets for nearly 3 decades. We've analyzed thousands of companies. But what you're about to witness today is something we have never revealed publicly in this form. Because for the first time in 15 years, Equity Master's leading small cap analyst is ready to reveal a system she has developed in recent years. A system built on promoter behavior. A system grounded in hard data and real world interactions. A system that has quietly preceded some of the most spectacular wealth creation stories in small and mid cap universe. This session is not a webinar or a presentation. It is a decoding. Decoding of a signal that has been hiding in plain sight for years. And the person who developed it is someone our audience trusts deeply. Joining us today is someone who has spent 15 years inside India's small cap universe. For 15 years, Richa Agarwal has traveled across India, walked factory floors, visited plants, met promoters and senior management teams face to face, analyzed businesses through dozens of quantitative and qualitative lenses, studied insider behavior across hundreds of listed companies. While many simply rely on screens, Richa relies on the ground truth. While others wait for annual reports, Richa prefers actual conversations with promoters. She looks beyond numbers, at promoters' intent, discipline, governance, culture, and conviction. And through this 15 years journey across bull markets and crashes, across winners and mistakes, across hours of field work, she has discovered a pattern she now calls the promoter's wealth signal. Richa, thank you for joining us today and congratulations on completing 15 years of deep on ground research here at Equity Master. Let's begin with the question every serious investor is silently asking today. What exactly is this signal you've discovered, and why is it extremely critical now more than ever?
Thank you, Tripti. What I'm about to share comes from years of on ground promoter meetings and Zoom interactions, factory visits, and 15 years of studying hundreds of small caps beyond what any screen can show. Here's the truth: the biggest moves and success stories in small caps do not begin with charts or financial ratios. They begin with promoter conviction. And one of the strongest ways where promoters show deep and real conviction is promoters buying their own shares with their personal money from the open market. Now, this is not about empty talk, boastful claims, speculation, or fragile guidance. This is backed by legal, transparent, publicly disclosed process, not opinion. As per market regulator, whenever insiders, that is promoters, directors, or key management personnel, buy or sell shares exceeding rupees 10 lakh in a quarter, they must disclose it to the company within 2 working days, and the company must report it to the stock exchange within 2 working days. Which means that every meaningful promoter or insider transaction is visible to you and me in almost real time. But here is the paradox. Although this information is public, yet it is not studied deeply and consistently. There are no easily available frameworks to interpret this data and to understand what genuine promoter conviction actually looks like. And that's exactly where my journey began with this signal. Over the past several years of my research, I have discovered a powerful pattern in multiple stocks across sectors where promoters buy meaningfully, buy even during the times when businesses face external pressure, and those stocks often go on to deliver extraordinary returns in the next few years. Now, this buying activity neither comes with hype nor creates big news. These stocks do not get labeled as hot. Yet, they deserve to be monitored because the people who understand the business better than anyone else, that is, the promoters and insiders, put their personal money to buy these stocks from the open market. And that is the foundation of promoter wealth signal. Today, let me show you exactly how this plays out, starting with one of the most extraordinary examples I've ever studied. Let me take you back to a moment almost everyone missed. The company in question wasn't a consumer darling or flashy new age business. In fact, it was quite likely to be labeled as a boring business. The company I'm referring to is Apar Industries, a company with 3 key business segments: electrical conductors, specialty oils, and transformer oils. Nothing glamorous or high margin brand story, just solid, industrial, boring work. In early 2020, its market cap was around rupees 15 billion or 1500 crores. By mid 2024, it had transformed into a 37,000 crore company. That's a staggering 25-fold rise in just 3.5 years. And here is what almost everyone missed. The real story did not begin in 2020. It began much earlier with the promoters. Between August and September 2018, the Desai family, Apar's promoters, quietly bought shares at around rupees 615. This was followed by another round of buying in August and December 2019. Even amid the COVID crash, when fear was at its peak and investors were dumping everything, the promoters stayed unfettered and bought 120,000 shares at 304. These were not small token purchases, but significant buying from the open market involving real personal money backed by strong conviction. Over the next 1 year, they kept buying, accumulating another 3 lakh shares between August 2020 and Feb 2021 at around 368 rupees per share. In that 1 year alone, they invested over rupees 14.5 crore of their own wealth back into their own company. They were showing real conviction. This was promoter wealth signal in the purest form. What happened next was a rise of the stock from rupees 350 levels to over rupees 9,000 in 3.5 years. That's a 25 bagger in less than 4 years. But the promoters were not guessing or speculating. They were signaling. Most retail investors may have not even seen it coming. Even many analysts may have missed the story in the early stages. So, Apar Industries is the perfect example of the quiet yet powerful way this signal works and often goes undetected.
Richa, this is remarkable. When you look at it closely, if someone had simply followed the insiders and bought around the time the promoters were buying, 1 lakh would have turned into 25 lakh.
Exactly. And this has nothing to do with luck, technical indicators, or catching the bottom either. This is about promoter conviction confirmed through action, not words. But it is not as simple as it sounds. You see, insider buying alone is never enough. After extensive study over the years, I have discovered something deeper. When three very specific signals line up together, the probability of a positive, strong, long term shift increases dramatically. And that's when we get a true promoter wealth signal. Let me break down these accompanying signals and show you how they come together. After studying hundreds of insider trades across dozens of sectors over the last 5 to 6 years, I realized something important, that promoter buying is powerful, but only when it appears alongside two other critical layers. The true promoter wealth signal is built on three clear layers. Signal 1, insider buying which is genuine, significant, and consistent. This is not about small symbolic purchases or one-off purchases or frequent buying and selling of shares, but genuine, substantial, and repeated buying by the promoters. In the case of Apar, this first layer was crystal clear. Sizable purchases, no conflicting insider sales, and recurring buying even during the times of fear and pessimism. This is the first and often the most revealing layer. The second signal is growth catalyst. You see, promoters may buy for many reasons. But the real question is there something positive brewing inside the business? In Apar's case, the company was making investments in high efficiency conductors and advanced technologies, making strategic expansions into specialty oil, growing more relevant in renewables, and making early bets on the next generation cables. The company had a clean balance sheet, low leverage, and a strong positioning in major national and global electrification themes. Basically, insiders were buying, and the real catalysts were building inside the business. Now that's a powerful combination. Coming to third signal, the valuation comfort. This is exactly where many investors get it wrong. Even if promoters are buying, you don't want to enter at irrational valuations. Promoters may buy to consolidate ownership, avoid takeovers, or show confidence. But regular investors need valuation discipline. So this filter ensures reasonable entry valuations, margin of safety, and growth runway still ahead. These three layers must come together, and when they do, the results can be extraordinary. And that is the foundation of promoter wealth signal system.
This is eye-opening. Every quarter, thousands of investors look at insider buying data, but many wouldn't know how to interpret it with this level of depth. What many wouldn't also know is that you are constantly tracking, monitoring, decoding the insider activity of hundreds of companies every single day. So, what you're showing us isn't a tip or a trick, but a complete framework.
Exactly. Promoter buying by itself is just noise. Promoter buying plus catalyst plus valuation, that is the signal. When all the three signals align, extraordinary things can happen.
Richa, the Apar story alone shows how powerful this signal truly is. But I know you've seen many more cases where promoter conviction aligned with business catalyst. Can you walk us through a few of those?
Absolutely. Let me show you two very different companies in very different industries that displayed the same three signals long before the market caught on. Do you know this company called Mrs. Bector Food Specialities? Most people know the brand it stands for today. But very few know the real story behind how it got here. It began in a small backyard in Ludhiana when a young woman named Rajni Bector bought a tiny oven for rupees 300 after learning baking at Punjab Agricultural University. From that humble start grew the Cremica brand, biscuits, breads, sauces, which later supplied to 60 plus countries and became a key supplier to the leading QSR chains. In 2021, the same woman who started with rupees 300 was awarded Padma Shri. The company got listed in 2020, but the real story for investors began quietly and almost invisibly in 2022. Because between March 2022 and Feb 2024, a period when most retail investors were worried about inflation, wheat prices, and margin pressure, something different was happening behind the scenes. The company insiders were buying, not once, not twice, but repeatedly at increasing price levels. Let me break this down using three signals. Signal number one, insider buying. The promoters of Mrs. Bector's Food Specialties went on a buying spree between March 2022 and Feb 2024. In March 2022, buying happened at Rs 282 per share. In June 2022, buying happened at Rs 270 per share. In August 2022, buying happened at Rs 356. In March 2023, the stocks were bought at Rs 500. In June 2023, the promoters bought at above Rs 800. In September 2023, buying was at 977, and in Feb 2024, buying happened at Rs 1001. Each time margins dipped or costs rose, the promoters bought more. No panic, no hesitation. This wasn't noise, it was conviction. Signal number two, growth catalyst. Speaking of growth catalyst, during this period, the company was expanding its popular English oven brand. It was also strengthening its leadership team and launching premium products. Besides, it was expanding direct reach across India, growing capacity, improving margins, and entering strategic partnerships with established retail chains like Walmart and Lulu. The catalysts were real, and insiders were confirming them with their own actions. Coming to third signal of valuation comfort, at the early stages of insider accumulation, that is Rs 270 to Rs 350, the valuations were still reasonable relative to the growth potential. That created the perfect buying window. Result, between June 2022 and September 2024, the stock rose 562%. That is, 1 lakh could become 6.6 lakh in just 2 years and 3 months. And once again, the insiders saw it long before the market did. Another example is Kovai Medical Center and Hospital, a quiet hospital in Coimbatore, neither a flashy metro chain hospital nor a social media favorite. It's run by a family of doctors with over 4 decades of experience. There are barely any presentations and transcripts on the company, and it's not a stock most retail investors will even pay attention to. But inside the company, something very powerful was taking shape. Let us apply the promoter wealth signal to this one as well. Signal number one, insider buying. In December 2020, the promoter's stake in Kovai Medical stood at 50.8%. Then something began to shift. In the last week of March 2021, the promoters began increasing their stake in the business. Once again, no token purchases, but strong, unambiguous conviction. And they continued buying over the years, even at higher price levels. As of June 2025, promoter stake stood at 56.55%. Coming to second signal of growth catalyst, Kovai wasn't a speculative story. It had a strong reputation in complex procedures, leadership in transplant surgeries, recognized innovations, which included steroid-free kidney transplant, brain aneurysm interventions, deep expertise in oncology, neurology, and orthopedics, a growing patient base, and operational excellence built over the decades. The company was also planning to expand beyond Coimbatore. For a medical institution, this is a kind of silent, structural, multi-year growth engine that insiders understand better than anyone else. Coming to third signal of valuation comfort, in March 2021, when the insiders bought heavily around Rs 1100, valuations were still reasonable for a business with this kind of durability. This made the promoters' conviction even more meaningful. Result: between March 2021 and September 2025, the stock gained over 450%, that is up 5.5 times. Sensex over the same period returned just 62%, and the gains in the small cap index were limited to 153%. Once again, the insiders acted early, and the promoter wealth signal picked it up long before the broader market did.
Richa, this is remarkable. Different industries, different business models, different cycles, and yet the pattern is identical. Promoters buy, catalysts are building up, valuations allow entry, stock re rates massively over the next few years.
Exactly, and these aren't cherry picked examples. This pattern has appeared again and again across dozens of small caps, and these patterns continue to appear from time to time.
The pattern is undeniable, but if the data is public and the disclosures are visible on the exchanges, why do so few investors benefit from insider buying? So, what stops investors from actually benefiting from this information?
This is a very important question, Tripti, because simply seeing promoter buying and understanding promoter buying are two very different things. The first is information, the second is insight. Most investors confuse the two, and that is why they struggle. See, one of the biggest misconceptions is the belief that if promoters buy, the stock will go up. No, insiders can buy for many reasons: dividend expectations, corporate restructuring, family stake consolidation, long term ownership goals, or avoiding hostile takeovers, and so on. Not every insider purchase is a wealth signal, and that is where most investors go wrong. They assume that every insider trade is a buy signal, which it rarely is. It becomes a meaningful signal only when three independent layers align: genuine, significant, and consistent insider buying, visible and strengthening growth catalyst, and the third one is valuation comfort that allows a reasonable margin of safety. Promoter buying alone is not a signal. Promoter buying plus growth catalyst plus valuation discipline. That is the promoter wealth signal. Most retail investors recognize this pattern only in hindsight when the stock has already multiplied.
So, the issue isn't the lack of data, it's that most investors don't know how to interpret it.
Exactly. Insider buying without context is noise. Insider buying with the right context is a genuine wealth signal. And once you start seeing promoter behavior through this lens, something shifts. You begin investing inside the story instead of outside it. And that shift alone can change your entire approach to the market. You stop guessing, reacting to hype and noise, and panicking during corrections. You start following promoter conviction, the most powerful indicator of all.
Richa, these examples are powerful. But I want to ask what every serious investor is probably thinking right now. How do I act on this signal? If someone spots promoter buying, notices catalyst building, and sees valuations are reasonable, what should they actually do next?
That's a great question, Tripti, and it's where most people misunderstand this strategy because this is not a buy today, sell tomorrow approach. It's not about momentum following, chasing spikes, or reacting to news. This is long term, conviction driven, promoter led strategy rooted in business fundamentals. Now, let me break down exactly how to use this strategy the right way. In my research across hundreds of insider cases, I have found that 3 years is usually a good time frame for this kind of signal to play out. Sometimes the stock re-rates faster in 10 months, 15 months, or 18 months. Sometimes it may take longer, 4 to 5 years. But 3 years is a sweet spot where catalysts unfold and reflect in the financials, expansions start delivering, margins improve, and market recognition catches up. Insiders' conviction becomes visible in performance, and valuations re-rate meaningfully. Now, see, this is not a strategy for the impatient. This is for investors who understand that promoter conviction takes time to translate into shareholder returns. Sometimes results appear quickly, like in case of Kilburn Engineering that went up 130% in 10 months, or in case of Mrs. Bector's which went up 562% in 2 years and 3 months, or Lincoln Pharma where the stock delivered 153% in 2 years. At other times, The real explosion happens after a long period of consolidation, as we saw in case of APAR Industries, which stagnated for a prolonged period before delivering 25x returns. The key is to follow the signal, not the price chart. Even with the most powerful signals, no one can predict which individual stock will deliver the biggest gains. But historically, a basket of insider-driven picks diversifies risk, minimizes downside risk, reduces dependence on any one catalyst, captures multiple long-term stories, and greatly increases the probability of strong overall returns. This is the most effective way to use insider signals. The goal is not perfection, the goal is high success probability. And that probability improves dramatically when you follow a basket approach.
And what about exits, Richa? If things don't unfold as expected, what should investors watch out for?
Well, there are two very clear exit signals that I monitor closely. The first one is promoters start selling meaningfully, and this is critical. If the same insiders who were buying earlier begin selling in a substantial way, that is a sign to watch out for. See, promoter selling can happen for many reasons: personal, succession, liquidity, etc. But substantial and repeated selling often signals weakening conviction, and in such cases, the signal starts losing its strength. The second exit trigger would be when the growth catalysts falter. These could be demand slowdown, margin collapse, weakening of the leadership, or regulatory pressures mounting. The expansion plans could fail or the business may lose momentum. And even if insiders still hold their stake, the rationale for staying invested weakens. See, promoter conviction only works when business conviction remains intact. If these two red flags do not appear, then patience is often rewarded.
Richa, everything you've shared so far has been deeply insightful. But I remember something you told me privately, that even with a company as extraordinary as APAR, most investors would have still missed the 25x opportunity. How is that possible?
See, this is where the psychology of investing becomes more important than the numbers. Now, let me walk you through what actually happened. We all saw the outcome, the spectacular ride of the stock from rupees 350 to over rupees 9,000 in 3.5 years. But if you zoom into the journey, you will see why most investors would have exited long before the story played out. The Desai family, APAR's promoters, first started buying shares in August and September 2018 at around 615. They bought again in December 2019. At that point, the promoter wealth signal was already flashing. But look at what happened next. The stock fell drastically. By the peak of COVID-19 crash in early 2020, the share price had dropped 60% from the levels where promoters had bought in 2018. And even after recovering from the COVID bottom, the stock hovered around rupees 600 for nearly 3 years. That is 3 years of no returns or excitement, but boredom, volatility, and doubt. Most people would have exited because the average investor looks for instant gratification. And when it doesn't come, patience and conviction evaporate. But here is what the insiders were doing during this entire phase. They were buying quietly, steadily, confidently, no mixed signals, no hesitation, and no conflicting behavior. This brings me to the most important lesson of all. Great multi-baggers do not always announce themselves early. In my study of insider-led winners, I have seen this pattern often, where promoters buy early, price goes to a stagnation phase, and markets ignore the story. Investors get frustrated, catalysts start compounding quietly, and then, suddenly, the stock re-rates explosively. That is exactly what happened with APAR. Promoters bought when order books looked weak, when analysts were questioning the business, the margins were under pressure, and even when COVID created chaos and demand was uncertain. No one on TV cared, but the promoters understood the undercurrents. The investments in high efficiency conductors, the boom in electrification, the positioning in renewables, and the long term strategy that was unfolding inside the company. And because they had conviction, they were willing to accumulate steadily even when the stock looked uninspiring from the outside. That is the difference between insiders and everyone else. Once the catalyst aligned, demand surged, margin expanded, renewables accelerated, global orders grew, and the company's years of preparation came together. The stock did not just rise, it skyrocketed. From the same levels where the investors felt nothing was happening, it went on to deliver 25x in just 3.5 years. That's the kind of opportunity most investors never experience. Not because it doesn't exist, but because they lose conviction before the story begins. This is exactly why the promoter wealth signal exists.
So, without this signal, even the most extraordinary opportunities can be missed.
Well, not just missed, but also abandoned too early. The promoter wealth signal is meant to guide investors through the stagnation, correction, the fear, the boredom, the volatility, the doubt, and the noise. Because when the people who know the business best are backing it up with their own money, consistently and meaningfully, it gives you the conviction to hold through the waiting phase. The explosion phase is always enjoyable, but the conviction phase is where long term wealth stories actually take place. And the promoter wealth signal is designed to help you stay in the story long enough to benefit from it.
They missed a par because they didn't discover it early. But the real reason is that most would never have held long enough without a framework like this.
Exactly. You see, finding great companies is one thing, but staying invested through their early uncertainty is another. The promoter wealth signal helps you do both because you're not just relying on hope, you're relying on insider conviction.
Richa, this has been one of the most eye opening conversations we've ever had. Before we close, is there one final message you want investors to take away from everything we've learned today?
Well, just one. And it's a message which I wish more people understood. You see, everywhere I look, family gatherings, social media groups, friends, colleagues, I see a strange obsession with the next hot IPO. Most people spend hours researching listing gains, tracking subscription numbers, comparing retail versus institutional participation, hoping to make a quick buck of 5, 10, or 20%. But here is the uncomfortable truth. Most IPOs are not wealth creation opportunities. They, in fact, are wealth extraction events. An IPO is often the moment when insiders or promoters sell a portion of their stake to the public. In other words, the amateur investor buys what the promoter is selling. But wise, seasoned investors do the exact opposite. They ride alongside the promoter in the one moment that actually matters, when the promoter is buying and not when he is exiting. That one shift from chasing what promoters sell to following where they commit their own money creates a completely different outcome over the long term. And this is the difference between noise and signal, trading and investing, luck and conviction, short term excitement and long term wealth, and lastly, between boys and men in the investing world. When you pay attention to promoter conviction, you're not guessing the future. You're aligning your actions with the people who understand the business best. And that alignment, quiet, logical, and disciplined, is one of the most powerful forces in the long term wealth creation.
That is such a powerful way to end today's session. To everyone watching, thank you for joining us. What you have heard today isn't a tip, isn't a prediction, and isn't a promise. It's a way of thinking, a way of evaluating businesses, a way of aligning yourself with conviction instead of noise. And if you internalize this even once, it can change the way you invest forever.